This is creating a perfect storm where you're running out of product because these firms don't want to take the liability of saying, listen, I'm going to commit to a trade. And then all of a sudden they go to put it on a boat and deliver it. And then Trump changes his mind. And then you have a massive loss right there.
Bob, I just followed you on Twitter. Shai talks a lot about you. Thank you so much for joining us this morning.
Sure. Thank you for having me on.
So I want to start off with the physical side with you, of course, right? Because this is your backyard per se, right? And what I'm curious about is the real demand for physical in this time right now, because obviously the futures, they're physically delivered. I think that's also something important for everyone to kind of understand, we're futures, network, gold, where if you want to get delivery, this is the place that you're coming to through CME Group. I'm curious, are people just price speculating right now? Is this just a hedge where you're seeing people coming in and just buying the price of gold, maybe the ETF? Or are you seeing real demand for people that want to take that gold in and store it in a vault?
Yeah, that's a good question. Really going back the last probably 2-3 years, you've seen a switch in demand from typical retail investors more to the high net worth institutional side, where they're saying, listen, I have absolutely no exposure whatsoever. I never believed in this asset class before. And now they're looking at it from an insurance policy standpoint or a hedge, whatever you want to call it, but getting some exposure. And that has dominated the trading or buying activity that the industry has been seeing. Yeah, really, the retail investor really started to disengage going into 2020, end of 2023. And then actually, as the market has risen, retail has been selling into that. There's been flurries of activity where you've seen some buying and pockets of excitement, that type of thing. But for the most part, it's really been on the gold side. You probably had people selling on every wave higher. Silver is an interesting one because silver has seen more and more demand from a standpoint of saying, listen, hey, the gold silver ratio is 106-1. This thing is relatively undervalued compared to gold, but gold is it's like a freight train right now. It's running over every ratio, every relative trade.
And let's talk about silver for a minute, because I particularly like that market. Obviously, it's a precious metal, but also an industrial metal. And it's been languishing. Gold still, albeit, in the 30s is higher than it's been. But what are you seeing in that market in particular?
Yeah, just for disclosure, I run a hedge fund. It's about 70% or so in silver, 29% physical gold, and I just started taking positions in platinum, just so I have some perspective here. But for silver, it's an interesting metal. You've seen obviously a pickup in industrial demand. The tariff situation has really caused some heartache. I think going back into December, you started to see banks become big buyers of the metals, especially in silver, taking big positions, putting it onto the COMEX, playing the EFP or the exchange for a physical premium, selling the futures against their physical position. And the tariff game kind of brought all that metal forward into the United States because of the concern of, hey, listen, if I have to actually deliver against my short position or my hedge in New York, I can't afford to pay a 25% tariff on top of my existing spot position. So a lot of that started the ball rolling back in December. We had a big blowout in exchange for physical premiums on all the metals. And then that basically contracted when the tariff situation had a little bit of reprieve. Bullion was looked at as exempted. Now what you're seeing, interesting enough, is that the Swiss refiners, the Canadian refiners or mints and refiners, the Australian mint, they're not shipping metal into the United States. This is creating a very interesting dynamic, almost like a perfect storm, so to speak, where you're running out of product because these firms don't want to take the liability of saying, listen, I'm going to commit to a trade. I'm going to sell, to my existing U.S. wholesaler, 1 million ounces of silver, for example. And then all of a sudden, 30 days later, they go to deliver, put it on a boat and deliver it. And then Trump changes his mind. And then you have a massive loss right there. So everybody is kind of holding their cards close to their vest. What that's creating is further tightness in the market. And that's what I've been talking about the last few weeks, is that we would be moving from large contangos into backgradations, and that the next stage of this market was going to be set by physical activity, not necessarily by the futures markets. And that's exactly what we've been seeing, is across the world almost, you've seen this pickup in physical demand. About a week and a half ago, you had a 12.5 ton trade go through the London LBMA afternoon fix in gold. Just over $1 billion of metal just bought, and on a snap. I mean, that's real momentum coming into this market, and that's obviously what's driving this sort of parabolic type of frenzy almost, is that there's this concern, obviously, with the dollar and with uncertainty and trade policy and so forth. That's sort of driving things. But the real question is, when does the white metals tend to catch up? And I think as this market broadens, I think that may start to pull these white metals forward. And that's where you start to look at, eventually the white metals start to take off and outperform gold.
And are you seeing the same thing in the platinum market as well? Are you including this in the platinum market?
Platinum is an interesting. There is literally not much metal out there. I mean, if you've been watching the CME stock reports, you've had 40% of the metal taken out of the CME in the last week and a half or so. Metal is going back outside the country. It's going where it's best treated. And now that there's no more big contangos to the ESP, it doesn't make sense to leave it on the exchange. Platinum is an interesting metal because, for example, you try and buy a couple $1 million worth of platinum out there, and it's good luck trying to find it. I mean, you have most of the platinum that's made is made by Swiss refiners, and they're very shy to ship any platinum into this country because of the tariff situation.
I want to talk about the ETFs. When you talk specifically about GLD, I don't know how much you know about this, but I'm curious, as gold prices start to run up, how much do the futures start to come into play where they have to buy futures to potentially get physical? How does that whole story play out? As when prices go parabolic, and anytime I see a physical commodity in an ETF, I always start to scratch my head and go, wondering, how much the futures start getting impacted by that.
Well, the authorized participants will use the futures to hedge their own inventory, that they interact with the ETF itself. So the ETFs don't really interact with the futures directly. And so you've had more players come into this market. But again, I think what people need to understand is the physical markets are very small relative to the broad financial system. It doesn't take a lot of money. $100 billion going into the platinum market, the physical platinum market, would just wipe it out. If you start pulling metal out of the system, not in the ETFs or in the futures markets, and take it out of the depository systems, that's going to delever the system. And that's what I've been saying was going to happen really since 2022 when Basel III got implemented. You started to see banks become penalized for their unallocated programs where the client wants to buy metal, the bank sells them that metal but backs the contract with their balance sheet instead of actual physical metal. Well, Basel III came in and started to penalize with these high reserve requirements that are needed to offset that transaction from the bank side. So you've seen more direct buying and the banks actually kind of walking away, actually moving their business more onto the exchanges themselves, rather than sort of the last 20 years of simply saying, listen, I'll take the trade, but I'll sell you into an unallocated pool of metal, which is basically a sponge that absorbs flow. Now you're seeing that dissipate, and you're seeing actual money coming in, taking out physical product. And that's why you're seeing the stress in the system.
It's super interesting to me.
Lou, I wanted to ask a question really quick about, what are your thoughts on, suddenly we're seeing India and China ETS or ETPs holdings kind of explode, where, before we kind of just a central bank buying, but now we're seeing more of the retail end buying. So what are your thoughts on that?
Yeah, they certainly, the flows, China has just exploded this year with regard to percentages increases of metal going into those products. Yeah, I think it's just a recognition that, the gold market is sort of looking at the big picture of, hey, listen, every country's in trouble right now, or every country's over indebted or levered. Economies are slowing down, uncertainty is picking up. These are things that drive. You have to understand, gold is a fear trade. It's not a greed trade. So fear is a much stronger emotion, and that's why gold, when it locks in, tends to be a very strong sort of, I mean, if you, like you say, if you step in front of this freight train, you're going to get run over. It's scary though, because when you get these parabolic runs, you never know when this thing's going to end. I mean, it could be an overnight comment by President Trump talking about, hey, listen, we're gonna pull back on the tariffs a little bit, and we're gonna maybe come more with negotiations. I mean, anything to kind of relieve the pressure or the stress or uncertainty. But right now, there's just a lot of fear out there, and I think it's resembled in not just the U.S. markets, but like you said, China, India, the currency markets, the leverage markets, the debt markets, bond markets. They're all seeing a lot of pressure here, and I think it's just people are looking for that hedge or that insurance policy that just says, listen, I don't want, I want to remove counterparty risk. I want to remove systemic risk. And that's, the gold and silver market, the physical market, are one of the few assets that can actually provide that coverage.
So many stories around metals right now. And this was really fantastic, Bob. I can't thank you enough. Everybody go follow Bob on Twitter at Profits Plus ID. You go there, he's got a link tree in his X profile, and follow his websites. Again, Profits Plus Capital Management and Idaho Armor Vaults. Bob, absolute pleasure meeting you. Learned a ton today in just our short little time together. Look forward to having you back on the show. And this story is going to continue, Shai. It's just going to continue. So, Bob, thank you so much for your time today. We really appreciate it.
Sure. Thank you for having me on.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.